All right. I don't know if you want to. We label this section of the Gray Report. What did I say?
Risks, red flags, loans, and lawsuits.
Wow, an alliteration, so lyrical, but it's an ugly reality that we are talking about.
Well, you can't get the returns and the rewards without taking some risk.
Yeah.
And we've got to go into all of this with a really clear head and having good information about potential upside and where you could get yourself into buying. That's how you stay out of it.
Yeah, I am asking myself though. So this first article here that in this section is about banks that are at risk despite declining interest rates. It is a report basically on a data set.
Remember what I said earlier about asking someone how much they know about the economy by asking them if interest rates are going up and down?
Yeah, exactly. These are the declining interest rates.
Continue.
Yeah. That probably called to mind, But the declining Fed funds rate.
And banks are more focused on floating on Fed funds.
Okay. I am asking though, is going into this. So we're talking about banks. Oh, now are banks in trouble because of high interest rates? I wonder, is this an echo of 2023 anxieties over regional bank performance? And amid those high interest rates, I think there are similarities, but I can't confidently make this comparison without a little more specific numbers, specific context. I did look into what was happening at the time, which is that in early 2023, rates had just gone up 200 basis points from compared to from January 2022 to January 2023. Rates have gone up 200 basis points. From now, if you're talking about now, rates for the 10-year at least, and for the Fed funds, they haven't really shifted that much. Fed funds have gone down, but if we're talking about the 10-year, the past year for all of 2024, it's been around 4 and 5, or 4.5 to 5, really. Even if you want to be generous, it's not so we're not dealing with that huge difference of 2 full percentage points. We're just dealing with the vacillations between 1%. And so I think that is the important context. But if you're talking about a snapshot, they do say of the 155 largest banks, 59 banks have exposures over 300% in the third quarter. Down, though, from 62, so there are 3 less banks than before that have exposures in that way. And the aggregate exposures to commercial real estate also decreased slightly in the third quarter from 138 to 132. So this is Q3 numbers when rates were a little bit lower. Especially, or 10-year, the 10-year was lower.
Yeah.
And so now they say banks are not in the clear as their unrealized losses are susceptible to interest rates, which, after falling from a recent high of 4.5 to a low of 3.6% on September 7th, have now risen back to 4.5 and above. And we know how that is. So they're talking about 10 years too in this situation. And I think that this is a snapshot of Q3 when it was the best interest rate environment.
Yeah.
And so now things are probably maybe a little bit worse. So I think, and I looked back, I may have mentioned this before, I looked back at previous quarters of this as much as I could of these numbers, and it seems as if we are doing slightly better. So the banks are doing a little bit better. They're a little bit more healthy than they were in previous quarters, as an ongoing trend. But I don't think that they're going to all be healthy enough to survive if interest rates, or not to survive, but to not make some serious decisions in 2024. My dramatic thesis, and now it's probably not true, right? is that banks are in a better position to withstand threats from CRE holdings now than they were in 2023, and that banks may be more apt to say, all right, I'm not going to give you a workout again in 2024, in 2025, like I was in 2023. So that is my thought, is that maybe there is a reckoning here, and a reckoning that can be productive, in that it frees up capital, it frees up opportunities for other people, and so I think that that sweet spot of like the imperative is there because of their holdings. They got to get their balance sheets right, but they're not in that crisis mode where they need to keep these guys on their books. Otherwise, like they're really responsible for a lot of loss.
You'd think if they've had the time to be able to shift things around, spread out
Yeah.
the risk of where it's not as concentrated, and be able to focus on the sponsors and the deals that can be saved and are worth probably kicking the can down the road, and which ones there's like just we need to face the music.
During Silicon Valley Bank in like March of 2023, 10-year treasuries were at like max at like 4%. September 16th of this year, treasuries were at 3.68%. And so we're having it there. There's a little bit of different worries. It's a little bit of a different context. So, and I don't think we're not dealing with the aftershock of a huge ramp up the previous year. We're just dealing with the persistence of high rates. And we'll see what that does. And like I said, like you said, maybe banks have kind of cleaned themselves up and cleaned up their books.
That's sweet. That is what we would like to think. All right.
Oh. This is when I want to quick callback to MSCI, which it signals underwater assets as an important context for the CRE market. So yeah, we got that bank thing going. We got this thing from MSCI. People are noticing this. You may brush this off. I'm sure it's not going to be a dramatic wave. We may not see headlines in the New York Times about it, but it is a factor of the market. Is loan maturities or distressed assets, or there's still pressure there, and it's still the persistent high interest rates will create some interesting opportunities, I think, for investors. I'm just going to read this out because I think it's significant. The apartment market has $19 billion worth less than the loans associated. I'm sorry. The apartment market has $19 billion worth of properties that are less valuable than the loans associated with them, accounting for 10% of maturing 2025 loans in that market. So there's a lot of apartment loans that are underwater. It's not a non-zero value. I know $19 billion isn't a lot in the whole context of things, but that's kind of crazy. That's a lot of loans. That's a lot of money. In some ways, the apartment market's huge and massive, but in other ways, in terms of the properties that are for sale at any given time, it's not like you have there's not a million for sale every time. It's just like a handful. It's smaller than you think is what I'm saying. In terms, if you're looking for like individual properties here and there, you'd be surprised. Like I'm always surprised at how many Katrina knows like every single apartment building in the city.
Once you're in it long enough, but there are still a lot of apartments.
Yeah,
it does start. The world becomes smaller once you've lived in it. But then, I mean, like every market is huge. I mean, it's a lot to know every. No one knows every apartment in maybe some people know.
Katrina does.
Katrina does. But like then expand that out to Cincinnati, Columbus, any other market, and then even a bigger market like Chicago. I mean, there's so much.
Yeah,
there's so much.
But again, that $19 billion worth of underwater properties, that I think that's a lot. I think that could create some real opportunities. May not move the full market, but it's nothing. It's worth noticing. It's worth keeping an eye out for. There's going to be some more real deal articles, some more gossip that's coming in, because I don't expect there's no interest rate reduction that could save some of these borrowers.
Yeah.